of the themes for today is it's a methodology. There are multiple methodologies of sustainability. This is a methodology that appears to be the only one deeply integrated with financial returns, financial statements, understanding the connection to financial statements. And it's based on Maslow's hierarchy of needs. So just like nature, we all need these things. We need to eat and drink. We need housing and clothing. We need hugs. We need to be hugged and touched. We have family. We need to feel good about ourselves, confidence and self-esteem. And we need to self-actualize. We're always working harder to achieve our goals. So this is not easy to adapt to a business exactly. So what we did was convert it into this framework. So the 5 groups of human needs on the left are health, wealth, earth, equality, and trust. So these 5 categories, health, wealth, earth, equality, trust, you can categorize your products and services into of the benefits to the customer. So if you're a hospital, your benefit is physical health or maybe mental health. If you're in financial services, it's helping your customers make more money to send their kids to school, pay for retirement, take care of parents. In earth, it's about being able to drink clean water, breathe clean air, not walk down the beach with garbage, but actually have a livable environment. Equality is about gender and ethnicity and citizenship, diversity. And trust is about being transparent, open, and ethical. So the reason why transparency is so important is if you don't know what the risk factor is, you can be surprised at any time. And investors hate surprises. So what we're able to do is these factors link to products and people and profits and the planet. And really the methodology for evaluating it is what do you sell, how do you operate, and how do you make decisions? So what do you sell? How do customers benefit? How are you running your company? Customer satisfaction, employee satisfaction, and management practices. Companies who score high on these, built into a diversified portfolio, tends to generate a portfolio that's lower risk and can be higher return. So I'm going to show you examples from companies, funds, asset classes, and portfolio. So what we're doing is taking this framework as a management system. So when I worked at McKinsey, the goal was find the metrics of which people can succeed, build it into a management system that you can use to run the business. And then if you design it right, and this is the key, you have to design it right, then you can intersect group benefit, building a better world, with financial success. So this is the process that we go through, which I'll explain with a slide for each of these. It is based on these quantifiable metrics, and it can drive the weighting of the portfolio. So these are examples from when we first started the HIP 100. So as you're getting the SET Sustainable Index underway, you might learn from this framework. So General Electric is an industrial business, as is something like SCG. SCG, according to its accounting, says that 26% of all its revenue has some ecological or social value. For General Electric, back in 2010, that was 12%. For SCG, it's 26%. So SCG has a high standard for its the environmental sustainability of its products, according to their methodology. PepsiCo, at one point, they don't do this anymore, but they had 3 categories of their products. Good for you, like orange juice, better for you, and fun for you. And fun for you is like salty potato chips. So it didn't say unhealthy for you, it said fun for you. So at the time, Pepsi had 30% of its revenue in these good and better. But what that also means is 70% of revenue was from unhealthy products. High salt, high sugar, things that cause stress, things that cause health problems, obesity. That's how their business model is built. Because we like salt. Our brain needs salt. Our brain actually performs better with some salt. Sugar feels good. As we were evolving as humans, when we had sugar, we'd be happy. But when you base your whole business on maximizing that versus optimizing that, you have a potential risk. And then Campbell's Soup, so this is a prepared food company. If you look at any soup in a can, most soups are like this, has high salt, very high salt, super high salt. So they were trying to bring the salt content down. But in some cases, some of the healthiest products, people stopped buying them. So the question for a company is this. If you addict your customers to an ingredient, and then to be sustainable, you have to pull out that ingredient, and your revenue drops, who's to blame? And how do you fix it? Because customers have stopped buying because they've gotten trained to something that's not healthy for them. This is a core sustainability challenge. How to take unsustainable behavior, by which we're all making money now, and shift it into a sustainable behavior. So these are the business problems for the next 5, 10, and 50 years. Take things that worked for a while but need to evolve and change them into something healthier. And Pepsi's competitor Coke, we might talk about this in a second, when you drink a Coca-Cola, how much water is in 1 liter of Coke? When you drink 1 liter of Coca-Cola, you're responsible for using how much water? Yeah, more than 2. That's just for the processing of the soda. Then if you account for the can and the delivery, and also if you drink a latte from Starbucks, 1 latte is 200 liters of water. The coffee, the sugar, the processing, the paper, the milk. So as long as all that water is falling from the sky, we might be okay. But if any of it's coming out of the ground, we might have a problem. All right, so that's part 1, is by industry and by company, evaluating the sustainability that will drive, this is all revenue growth. This is all top-line revenue growth. Then these are a number of measures, some of which we've talked about, that are quantifiable measures about customers and employees, environment, greenhouse gas emissions and waste reduction, compensation of employees and CEO pay, and things like supplier diversity and certifications. What we've done is we've taken these quantifiable factors from the 7,000 companies over going on 10 years now of data, and we've done regression analysis and back tests on how these factors connect to cash flow and shareholder value. And we've built portfolios out of these factors and looked at how to optimize to get the right coefficient. And we took these factors and we said, if we were going to put them on the financial statements, how would we book human capital as an asset? What would be the true cost of energy and greenhouse gas emissions? And so that's what we've done. And so the weightings of the HIP index, which are trade secrets, but these factors create value or reduce risk. And we've talked about several of them so far. Then the third, and we haven't talked about this yet, is the management practices. So to have innovative products and to have a company that runs those operating metrics, this is what you need to build into the management system. This is the foundation, the building block. So one is the vision. What is the vision of the company? Not just growth, what human need are you solving? Are you making people healthier? Are you making water cleaner? Are you bringing low-income people to be more inclusive into society? That is what gets people motivated. So today's millennials age 20 to 35. There have been a couple surveys now about what matters to age 20 to 35 millennials. They asked them this question. One survey is from Deloitte, one survey is from Telefonica, the Spanish-based phone company. What is the number one purpose of business? What do millennials say? How about for you? What is the number one purpose of business? What's that? Profit. Traditionally, in recent times, that's the number one goal is profit. To millennials, age 20 to 35, the number one goal, to make the world better. And number two, profit. So using business as an engine for good. So millennials will be good customers, good employees, and good investors when you build a better world. And do so financially sustainably. So millennials aren't saying just do good, don't make profit. They're saying do good. If you do good, it can make a profit. So I guess that proves I'm getting younger, right? By working on sustainability. So one is, what is the vision of the company? Two is, if that's the vision, what are the performance metrics? Now, usually you can only have 5 metrics total for everybody to focus on. And obviously one's going to be profit. Hopefully 2 is customer. Hopefully 1 is customer, 2 is employee. 3 is profit. So that leaves you 2 others. Customer, employee, profit, and 2 others maximum. It could be environmental, could be social, could be anything. Could be learning or innovation. So if you ever use a Post-it, the company that makes that is 3M, Minnesota Manufacturing. Their business goals are every business manager, their revenue, 30% of their revenue has to come from products in the last 3 years. Invented in the last 3 years. So with that goal, you're always inventing. That's what they've chosen to do. Then understanding how these measures link to the financial statements, that's what we're talking about here. How does customer satisfaction link to revenue? How does employee satisfaction a positive return on investment and a positive balance sheet value that is invisible today? And you can also have things like tax credits. So solar tax credits can be government subsidies, for example. The accountability is critical here. Where sustainability sits in the organization will determine how successful it is. If it sits at the board, it can be the highest leverage. If it's only at the executive team and not the board, less likely to be successful. If it sits in a middle manager or lower, unlikely to be successful. So the companies who build sustainability into the board committees, board discussions, board agenda, and board decisions, the rest of this happens. Nature acts naturally. And when it's operating at its highest potential is when sustainability is a part of every management process. From research and development, what products get developed to solve which human needs, to capital resourcing capital allocation. Where are we allocating not only financial capital, where are we allocating people capital? Where are we putting our highest talented people on which projects? And performance reviews, making everyone accountable, making every individual accountable. So we convert these into numbers to get an overall HIP score. So this is actually a 20% weight, not a 10% weight. This is another 20% weight. We multiply these out. So essentially what we do is we collect all this data, we quality check it, we then run peer performance against competitors, local and global competitors. We also look for improvement year over year, and that ends up calculating a 0 to 100 HIP score. So a higher HIP score of 100 is better, a lower HIP score of 0, not very good. And then we build portfolios by weighting by the HIP score. a future, what we think is a future-looking measure. So not just looking to the past of financial statements, looking to the future. And that's why it works. So in the case of the HIP 100 at the beginning, Procter & Gamble, GE, and Intel were the top three. At that point, they had scores about 70. Those scores change over time as they become more or less sustainable, or when competitors run up. So Colgate-Palmolive, which is not listed here, basically became very sustainable and exceeded Procter & Gamble. Intel is the current #1 company on the HIP index. It's not to say that companies are perfect. No company is perfect. It's impossible to run a perfect company. But these companies are better. They're more focused, more accountable, and more sustainable. So we don't look in the rearview mirror for market value. We look out the front windshield for HIP value. And this is the performance as of the end of last year. So this HIP 100, and we'll be updating this for yesterday's 5-year anniversary. The gross performance is 107% over 4.5 years. And the benchmarks were around 80. We have a real estate index. So on a gross, it was 15% versus the benchmark. It had some high expenses at the beginning, so the net is lower. That will realign over time. And then this is the best companies to work for strategy for a partial year, before we showed you a full year. For a partial year, 18% versus just under 16%. So we take these strategies, and these could be similar strategies to use at SET or in Thailand, or to create an ASEAN index listed on SET, invest in ASEAN through SET. And you could do a top 100 strategy, you could do a real estate strategy, you could do a best companies to work for. We also have a global dividend strategy. So to date, at least for the time period, for the size that they are, that's why some of the nets are lower, these are smaller dollar amounts, the strategies work, because they're looking forward, not looking backward. So really it's the intersection of solving human needs. This is what motivates us as people. We self-actualize, Maslow's hierarchy of needs. We self-actualize when we help other people and we help ourselves. And if you can build a business engine around that, you sort of have a dream job. So HIP stands for both higher impact and profit and higher impact portfolios. All right, I'll just take a quick pause here because I've been talking continuously. Are there questions? No questions? Perfect understanding? Great. So companies end up getting plotted on a 2x2. So this is at IMBA at Thammasat. This is always the first class that we do. Everybody thinks of a company. We're going to do this right now. Everybody thinks of a company. It's very simple, 2x2. Think of a company, could be your company or something else. And then plot it where you think it is. If you think it's high human impact, solving human needs, and it's profitable, put it up here. If it's profitable but negative impact, put it here. If it's solving a need, maybe like government, but not profitable, you can put it here. Hopefully nothing's here. Usually somebody put Malaysia Airlines here this week. We've also put gambling there for the person. Gambling is good for the casino. All right, so take 30 seconds and do that. Think of a company and put it on this grid. And if we're in class, you'd all come up to the board. All right, anybody put anybody in this box? No? Anybody put anybody in this box? High profit, low or negative impact? You did? Which one? Which one? Oh, you don't want to say? Anonymous? Okay, did everybody pick the top right box? Okay, which company did you pick? or organization?
Microsoft.
Microsoft? Okay. So how are they positive impact?
Actually, because I'm from Microsoft, right? So I
Okay.
have seen the investment in human
Yes?
for almost every level, mid-level and upper level management.
Yes.
At the same time, I think it's the company that make a lot of profit though because of their sales license.
Yes? Okay. So you think it's in the top right?
Yes.
Yeah, okay. And you're excited about that working there?
Not quite sure at this moment.
Okay. All right, sounds good. All right, who else put something that they would like to share with everybody? Yes? What about you? The chairman has asked that you reveal your answer.
Yeah, we own the refinery and we have the service station. At the same time, we also have the solar farm.
Yes?
We do the biodiesel plant.
Yes.
We gonna own today we're gonna own the one of the ethanol plant.
Yes?
So along with our supply chain, we do several CSR in process.
Yes?
Like the one we use the community produce as our giveaway at the service station promotion
Yes.
campaigns. We also buy the used cooking oil as a feedstock for biodiesel production.
Yep.
And we give the opportunity for the agricultural cooperative to open the service station for their own member use.
Great.
So they can have the more stable income and
Yes.
learn how to do modern business.
Fantastic. So what, if you can share, do you track for the positive products, the percentage of overall company revenue?
Yeah. Or for the share for the sale of the cooperative.
Yes?
Service station has been increased every year.
Yes? Okay.
And can be contribute to more than 4 million family of the farmer.
4 million people? Yeah. So 5% of Thailand's population?
4 million family.
Families?
Yeah.
Yeah, so more than 5% of Thailand population. Okay, that's fantastic. All right, so that's solving a good human need and profitably too, yes?
Including the environment.
Yes. Yes, okay. All right, other examples? Any quadrant? Nope? All right, well, feel free to do this with your friends. Helps for hip branding, too. So the HI, the human impact, is sustainable for society and stakeholders, and the profit is sustainable for shareholders. So when you're here, you're sustainable for both. Like we talked about here, this may not be sustainable for shareholders, but this is not sustainable for society. So being able to understand your own sustainability and plot it against competitors, that's one framework that you can use in the boardroom or in strategic planning. Or looking inside the company, you could do this by business unit. So you could look at the cooperatives versus the other business units and see who's where. And that's where you can start to create internal competition to serve more human needs and profit at the same time. So you can use this internally across business units or across departments to stimulate that. You could even, and our customers sometimes ask us for this, they want to compete against other customers. So in investing in portfolios, I want to find the highest sustainable companies and compete against other investors. So you can look at this from a corporate competition, a internal corporation business unit competition, teams within a corporation, or investors. So some of our work is working with institutional investors and family offices, as well as family foundations, to plot across asset classes where different asset classes. So these are government bonds that are tax deductible, called municipal bonds. This is private equity, which is both sort of large private equity or venture capital. It's easy to be more focused here. This is publicly listed mutual funds and ETFs, so there's a wide range of publicly listed companies. And then hedge funds, because hedge funds usually can't see inside them. So if you make money, you don't know why, and if you lose money, you definitely don't know why. And that's the way they like it. So that can blend into a portfolio average. And sometimes you get in this debate of, well, why not just invest in the index? Because most indexes are built on stock market value. So you're only as good as tracking the stock market value. If you see something that the market does not, and it works, then you might be able to outperform the index. So on a particular year basis, 1 in 4 managers can outperform, up to 2 in 4, depending on the year. So active stock picking can work, including in sustainability, just like we showed you. So this is our air traffic control chart. This is something we do for institutional investors, family office. These are all their asset classes. And reporting-wise, in addition to reporting their return and their risk, we also report their impact. Now, this is a very quantitative chart. If you're excited by this chart, I want to talk to you. But usually what we do is we convert it to this. This is a very friendly chart. Most people can understand this chart. So this is financial risk, financial volatility, and this is return. And this is the efficient frontier line, if you remember finance. And usually you plot portfolios, but we use it to plot funds, asset classes, and even companies. And when return exceeds risk, something will be above the line, and when risk is higher than return, it'll be below the line. So out here, for this allocation, these companies actually lost money with high risk, these asset classes. Whereas these allocations in the portfolio, several of them are above the line. And this is pretty typical. About here, you can usually invest safely in fixed income and real estate pretty predictably. Anytime you break this midpoint, you don't know whether the performance is going to be this or this. Higher risk is not only higher return, higher risk is higher risk. So as we show a customer something like this, because cash is paying 0 now, this is the cash bubble. 0 risk and 0 return. But it's red. Why is it red? Because the HIP score of where the cash is a very low score. It's in a bank. The bank doesn't tell you how you're investing your cash. So it's not transparent. And it's likely going to things that you wouldn't agree with if you're sustainably minded. So the client said, I don't want to be there. So we invested their cash in a sustainable bank that makes loans to sustainable enterprises of those high growth markets like organic food and renewable energy and the like. So over time, for any time period, these bubbles can be above or below the efficient frontier line, depending on risk and return. And the colors can change over time based on the components of what's inside. So you can change the color of this bubble by changing what's invested. So these are private notes in companies. These are real estate funds. The interesting thing about real estate is you build something at the time, and it's very difficult to change it later. So if you build it unsustainably at the beginning, it's only going to be more unsustainable along the way. So this is actually something up front, and we've had discussions with several real estate investors and really more building improvers. There's now products that will automatically change the tint of the glass so that it lets in more or less light throughout the day. So they program in the sun to know when it's going to hit the building. They get a download from the weather off an app. They predict what the energy and light is going to come through the window, and they'll auto-tint the window. It's pretty amazing technology. So they came to us and they said, who should we go talk to about this? Who are the sustainable real estate companies where this would appeal to them? So one of the other uses for the HIP ratings besides companies and investors is sales targeting. And somebody else came to us, an architect, and said, same on real estate, who are the product companies that we should seek out to make sure their products are in our sustainable buildings? So a sustainability rating of looking forward has many uses. It's a communication to your customers. It's a motivation for your staff. It's a telegraph to investors that you are respectful of them, you want to share information, and that you can let them look inside your business